Well, Cannon Asset Managers has over 3.2 billion rand of assets under management. The Cannon Flexible Fund invests in two asset classes, namely deep value equities and cash. For more, Andrew Newell from Cannon Asset Managers joins us right now in the studio. Andrew, always a pleasure having you with us. Let's start in terms of the performance we're seeing from the Cannon Flexible Fund. Are you shooting the lights out?
To say we're shooting the lights out is probably misleading, but I think what is very pleasing for us is the fund is delivering on its objective and mandate very well. And what we are essentially trying to do is, over the long term, to capture equity-like performance with less than equity market volatility or risk, as some people describe it. So in that context, we're doing very well. It helps that we are able to hold both cash and equities. So in the current volatile environment, we do have a small cash portion in the fund, which is giving us a buffer of sorts.
What exposure have you got? Sorry, Ashraf. What exposure do you have on the equity front?
In terms of underlying stocks?
No. This is in terms of equity versus cash. You said a small holding of cash right now.
So at the moment, we are probably more aggressive than you might expect. To answer the question, 95% equity, 5% cash. And the way we run that asset allocation decision is we've assessed the market on different valuation metrics, and once the market becomes so attractive, we'll allocate a set portion to equities. Given the market's recent sell-off, we find it very attractive on a 3-year view. That is shouldn't be in the small print, that's in the big print. And given that stance, we have an overweight position to equities.
Ashraf, these are brave men in the equity space.
Especially when one considers the volatility in the markets, which Andrew alluded to earlier. I mean, you know, you have said it's a 3-year view, that's your rider, and that's what you'll deliver on. But also it doesn't give you space to maneuver when we have another pullback of 10 to 15% in the near future. I mean, I've been speaking to a number of fund managers, especially those on the balanced fund side. And on an asset allocation basis, I can certainly say that they have a higher cash weighting than you do. So I'm quite impressed, given that I know Adrian quite well, and you know he's extremely conservative. So you know the matrices that you guys apply must certainly be pointing towards quite an aggressive stance right now.
They are, given that we've got such a high weighting to equities. I think a different way to position our argument is to consider that the Cannon Flexible Fund specifically is a retail unit trust, which is a bit more aggressive than our institutional comparator, where we have 75% in equities and 25% in cash. So speaking to the balanced investment community, that's probably a fairer comparison to draw. But having said that, we do remain quite highly invested in your capital appreciation asset classes, being equities and property in the balanced space. The volatility that you raise is there. I mean, you don't have to look very hard to see it. What we are...
Can I jump in here? I want to look at this industrials, resources and financials in terms of your sector allocation, 40% into the industrial game. So specifically, what stocks are we talking about here?
We are, if you look at the super sector allocation, we're almost equi-weighted relative to the index. So at first glance, it doesn't look like there's very high conviction. But if you dig down and address your question on the specific holdings, you see some very different names coming through. Perhaps an easier way to answer the question is to tell you what isn't there. We don't have... Well,
I'm glad you're going to answer the question one way or another.
At my third attempt. So what we don't have is South African breweries, Naspers, Richemont, the headline retailers, and the like. The big industrials is a very short way to describe it. What we do have is companies which are more South African oriented in terms of their business facing operation and where they draw their revenue from. And the reason for that distinction really is the valuations being applied to those two different sectors are very different. It's fair to say that the big industrials have done well.
Two small industrial examples, then I know Ashraf wants to jump in. So give me 2 examples of where you are invested in this industrial space.
One of the holdings which we've recently introduced is Trencor, mostly a shipping and container-based business. And another holding is a motor vehicle parts business, which we've held for some time, called Metair, which has done very well, but we continue to find value there.
Now, it's your top holding that I really want to ask you about. I mean, the results for Anglos came out last week, etc., down 38% on a headline basis. How are you guys feeling about that? Because, you know, it's certainly caught the market off guard. We saw the price action post that, and then price action today as well. It was under pressure relative to the rest of the market. You comfortable with that position right now?
Well, it depends on your perspective. Certainly the whole sector has been under pressure. Anglo American specifically has a couple of things which have placed it under pressure. Obvious examples are the 80% shareholding in Anglo Platinum. We know the story in the platinum sector over the course of this year. That's been a big drag on them. What is disappointing from our perspective as well is the additional delay in the Minas Rio project in Brazil, which is meant to be a big contributor to revenue for them going forward, and it seems to have been pushed out by another year. So late 2014 is when kickoff will happen, we're told. We still think that there's excellent value to be had in the project in the life of Anglo American, but it is frustrating that it is postponed.
And your view on Sasol? Sorry, Bronwyn.
No problem. I want to stay on Anglo American. So, in terms of your high conviction in the Anglo American space, would you use this pullback, sir, to buy some more?
We are still buying Anglo American, yes.
Well, there we go. Now I've got conclusion on Anglo American. You wanted to go on Sasol?
And your conviction on Sasol, is that really because of the higher oil price or the new projects that are coming online?
Well, it's a bit of both. I mean, that's a very half-hearted answer. I mean, they are buoyed by the oil price. They are oil price dependent. And so the rally in the price over the last few weeks is very helpful. We remain of the view that the technology that they have is a key advantage. But you can't hide from the fact that a higher oil price is good for Sasol.
But I mean, that key advantage seems to be slipping away, you know, as the years carry on.
Yeah, I think it's less.
They need newer technologies because there are newer technologies coming out in this marketplace, making it cheaper to convert those, those assets into fuel.
Yeah, I think they don't have the same, monopoly is not really the right word, but the same sort of competitive moat in the technology space that they did. They still have very good technology at their disposal, but certainly they do need to broaden that and refine it, if you'll pardon the pun.
Are you waiting, like the rest of the fund management community, for a re-rating of Sasol in the international space? And that, of course, will then deliver rewards, enormous rewards in terms of Sasol's share price. Do you think that's the strategy that a lot of fund managers have undertaken?
I mean, it's very difficult to know what they're waiting for.
But you must have heard that argument,
yeah,
that the international fund managers don't appreciate the value in Sasol. When they do, it could potentially shoot the lights out.
Potentially it could, and potentially they don't appreciate it. I mean, a behavioral finance person would say that's just looking for confirmation of why you've bought it. And maybe it's true. Waiting for what another investor may or may not do, I don't think is a very good strategy. You need to, if it works, it's fortuitous. We think that there's value in the business in absolute terms. A rising oil price will help. There are question marks over what should the oil price be given global growth concerns. So the move towards the $110 mark is positive. But regardless of what the international investor community is thinking or waiting for, supposedly, we think it's a good investment opportunity.
Standard Bank and Nedbank are two core holdings on the financial side, Standard Bank being the bigger exposure for you. But by the same token that you may have been upset with Anglo American's results release, you would have been relatively happy with Nedbank's trading update. That bank looks as though it's really got its act together.
It's amazing, you know, if you just step back a couple of years and ask people about their perceptions then about the banking industry. Nedbank was, if there are just 4 banks, they were 4th out of 4. And they have done very well. So we're pleased with how they've delivered on their promises or their objectives. They have run quite hard. We still think that there is a little bit left in Nedbank, but they certainly aren't the attraction that they were a couple of years ago. Standard Bank has not quite kept pace with Nedbank, and FirstRand has also done quite well. But we see a little bit more upside in Standard Bank, but slightly different opportunity set. Standard Bank more looking to move north of the border. Nedbank is, generally speaking, more South African oriented.
But, you know, having said that, we've seen a lot of bad news coming out of ABSA, a lot of reconfiguration happening within the business. Do you not see the opportunity there right now?
So the short answer is yes. Any time the price moves as hard as it has, it makes it more attractive. From our perspective, what we don't want to do is rotate into a different bank because it has sold down by 10, 20 or 30%. If your quality...
But doesn't that constitute deep value?
Well, that's where I was getting.
You see, I'm ahead of you. You've got to be smart and snappy with your questions here.
From a pure price perspective, yes, it's more attractive. That's the very short answer.
You must have bigger concerns about ABSA then.
What we want to see across the board is that the price action is not a reflection on potentially deteriorating quality within the business. That's not to say that the quality of the ABSA business has deteriorated, but naturally the reason for the price action raises question marks as to why these weren't picked up and or flagged earlier. So from our stance, we will retain the position in Nedbank and Standard Bank in the flexible fund unless or until such time that we become more confident in the quality attributes of ABSA and their price hasn't moved back up.
Okay. Now, just to go onto your industrial holdings, and I know it's not a significant holding per se, but always fascinates me, Avenge. You're still very bullish on that holding.
Yes. After 2 years, we are still bullish on the holding. So, I mean, to preempt a question, we have been early to the sector. It's not just Avenge that we have exposure to, but they are our largest construction position. And the difficulty there has been, as price has fallen, and this makes me immediately think of the ABSA question, should we be either exiting or buying more as a deeper value? What we like within the construction sector is, notwithstanding the infrastructure and the economic stresses in which they operate, the balance sheet remains very strong. They've got a lot of cash. It's helped them weather the storm. I see in today's paper there are murmurings of the Free State Roads Agency verbally committing to pay some of their contractors.
Oh, good, we've got a verbal commitment on public sector spend in the infrastructure space. This is good.
It doesn't include Avenge, but if you speak to management of the various construction companies, given that they will probably have some euphoria or optimism to their own businesses, the mood is better than it has been for some time. They have not previously said we are at the bottom and the light is at the end of the tunnel, but it seems like that's actually starting to come into the conversation. So it gives us confidence that the quality businesses in the sector are ready for a re-rating.
Andrew, we're out of time. Thanks so much. Andrew Newell, Head of Business Development at Cannon Asset Managers.